Well, Inderes TV viewers, we just released a new extensive report on HKFoods, and today we will talk more about the company with our analyst Pauli Lohi. Hi, Pauli.
Hi, Sarah.
In recent years, HKFoods has scaled back in its international operations and mainly focused in Finland. So, could you summarize to us how does the business currently look like?
Well, HKFoods has come back to its roots and now focused mainly in Finland. They still have a small bacon unit in Poland. They didn't divest it because they didn't get the high enough valuation for it, but it's profitable, so they are keeping it for now. And but mainly focusing in Finland, where they have very close relations to the primary production, like cattle farmers, and they get animals from the farmers and then slaughter and cut the meat and process the products and sell them with their own brands, mainly in supermarkets and other retail channels, but also in food service and they have also some exports and some sales to the industry. But I would say that retail is the most important channel.
Yeah, that's a good summary. Well, the company's transformation seems to have driven the share price higher. So why were these divestments made in the first place and how have they helped the company?
Well, the company has been in financial difficulties for years, and with divestment of Swedish and Baltic and Danish operations, they could improve their balance sheet and improve their ability to invest to the Finnish operation, and that has had a big impact to Finnish profitability, because now they actually have more efficient operations. In this industry, you need to invest so that you are not, let's say, wasting money for inefficient processes. So that has been a big change for them, and they have been vastly improving their profitability from maybe some 1% in like 4 years ago, and now we are expecting over 3% EBIT margin for this year.
Yeah, that's good. Well, overall, the industry's growth prospects are rather modest. Does HKFoods have growth opportunities given that the red meat consumption is also slightly declining?
They have opportunities. If we look their business as a whole, I would say that the growth profile is quite modest because the red meat consumption is in slight decline, especially for pork, and less so for beef, but maybe a little bit. But then poultry is growing fast. I think it grew like 4% a year as a volume basis in the past 5 years. And then they also do many kind of products that are not actually meat products, but more kind of ready-made meals and meal components and all kinds of more processed products that give additional value to the consumers. And for example, the ready-made meals category has been growing 8% in volume in the past 5 years per annum. So that's a quite rapid growth in the food industry context.
Yeah, for sure. Well, the food industry is defensive and low margin and highly sensitive to rapid inflation. So how does the consumer demand and the cost environment look right now?
Well, if I start from the cost environment, there was a couple of years ago, there was very high inflation due to the Ukraine war, and that really hurt the whole industry. And now the situation has been more stable for the couple of 2 years, which really has helped also with the profitability turnaround. There has been maybe some slight inflationary drivers recently, especially regarding the beef price, because there is less production and less supply for beef, animals here in Finland compared to the consumption. So the beef price is up, but HKFoods can definitely compensate with increasing their selling prices. So I would expect that situation to stabilize during the autumn. But in general, quite stable in the inflation. Regarding the consumer demand, that has been quite sluggish this year, both in retail and food service. But there is expected recovery. At least Nordea expects private consumption to improve next year. So I would believe that declining interest rates also would affect consumers' behavior.
Yeah, we'll see. Well, the company recently raised its profitability target. So do you believe it can still improve their profitability further?
Well, I think that they have opportunity or potential for it. Currently, we model in 3.2% EBIT margin for this year, and we expect it to increase to 3.4 and 3.5 in the next 2 years. So it's quite modest what we are currently modeling in, and their target is above 5%. And key competitors are doing 4.7%. So there is room to improve if you look from the industry perspective. I think that the most obvious ways to improve profitability have been done already. There's still some impact to be seen from the most recent investments. So that's why we expect it to increase. But I think we are a bit modest with our expectations because of the historical difficulties the company has had. And to meet competitors' profitability levels, I think they should still increase the amount of investments. And I don't yet see that they could match what for example, Atria is investing currently in Finland.
Yeah. Well, the company has been able to decline its debt level, but it's still rather high. So how does this affect the company's investment profile?
Well, definitely it has improved kind of the quality or decreased the risk level, I would say, so that there is no immediate threat of financial troubles for this company. It's more kind of question at what price you can refinance your debts. But now they refinanced the hybrid bond, which had very high interest margin of 60%, and now it's 8.7. So the cost halved from that, and then they have a big bond that they can refinance in the next 2 years and save lots of interest costs based on the current trading yields for that bond in the market. So that will definitely leave more room for dividend, for investments, and to further decrease the level of indebtedness or debt. So I think the quality and risk level are going for good direction.
Yeah. Well, lastly, we continue covering the company with accumulate recommendations. So could you tell us, Pauli, why should one buy HKFoods stock?
Well, I think it all comes to the profitability turnaround, and I still believe that there is some room to improve even with the current investment level, which is actually better than it used to be in the history. So we already believe that with current year's estimates, it's EV/EBIT 10, which is pretty close to fair level. But we are quite modest with our estimates. We don't have any earnings growth for second half in our estimates. We expect improvement in profitability in 26 and 27, but just a couple of tenths of a percentage point. So it's modest, and with next year's estimates, EV/EBIT declines to 9, and PE for 2027 is only 8, and it declines fast because of declining interest rate payments. So I think that a turnaround still continues, both operationally and then in the financing cost perspective. And there's also possibility that they can improve more than I have in my estimates. So then there would be quite high correlation or a strong link to the share price if they can improve even a little bit more than what I have been modeling in.
Yeah, good. Thank you so much, Pauli, for enlightening us about the company.
Thank you.
And thank you all for watching. Remember that you can read the new extensive report on Inderes.se for free, and also remember that you can follow the company there also, so you get notifications for all the materials regarding the company. Also, feel free to continue discussion about the company with us in our discussion forum. We'll see you again in next videos. In the meanwhile, remember to read analysis and make it investing decisions.